I will start this week in the traditional way, looking at rates and yields. A couple things to point out. Let's start with money market rates, and let's just look at the 1 month and the 2 month, especially the 1 month. 5.56, 6 basis points above the Fed funds rate. Why would that not have been bid away? 5.56. But there it is. I don't know. Maybe it's something to do with the long weekend, but why there isn't more activity there, putting it down to 5.5 or below 5.5, I don't know why it would be above that. But I think it's something that bears watching to see if it stays above that level. As far as the capital end of the curve, the larger increases were at the 2-year, and then they sort of just tapered away. Once you get to the 20 and to the 30, there doesn't seem to be a lot of volatility going into that based on the Fed speak that we've been hearing about. Well, maybe it won't be 3, maybe it'll be 2, maybe it won't be 2, maybe it'll be 1, maybe there won't be any rate cuts this year. And the long end of the curve seems to be handling that okay. This is where TLT lives. And we'll see that TLT, for better or for worse, is basically unchanged over the week. I mean, it had nice run-ups and then sell-offs, and then a run-up and then sell-off, and then pretty much ended right where it started, with leaving us with 0 implied volatility in there. So volatility in the long end of the curve is disappearing. Looking at curve inversion is getting a little tiring, isn't it? The 2 to the 10, 676 days at this point. Curve inversion deepened, -47 for the money market to capital market inversion, 559 days. We are, 2.5 months away from the 2-year anniversary on this one. And here we are. If you hid all of this information from me, and you gave me some data points, you gave me S&P 500 earnings per share over the last, let's say, 2.5 years. You gave me GDP over the last 2.5 years, and you gave me unemployment over the last 2.5 years, and let's just throw in the jobs report in there as well over the last 2.5 years, and you said, based on that, draw out what you think is your best guess as to what the yield curve looked like over the last 2.5 years. I'd be drawing something like that. And if you said, no, it's actually like this, I would have said, well, then your data's wrong. Either you're collecting data incorrectly here, or this data is wrong, or this data is from a particular market, and the yield curve you're giving me is from a different market altogether. Because from an empirical perspective, it doesn't fit. And it is fitting that if we look at what the topic of the Jackson Hole Symposium is this August, I think it's the right question to ask is judging the effectiveness of monetary policy. Because when you have curve inversions for this long, yet you have EPS, GDP, unemployment, jobs report, all suggesting that the yield curve must look like this, the question has to be asked, does monetary policy even work anymore? And I've made this point many times. The U.S. is the home of global innovation. No matter how you look at it, it is the home of innovation, of radical innovation. Maybe some other countries do incremental innovation better, like maybe China, maybe Japan. But as far as breakthroughs, it pretty much all happens in the U.S., including financial innovation. What if you get to a point in an economy where you can absolutely immunize yourself from monetary policy no matter what they do? Which means you have the ability to hedge out all interest rate and inflation risk altogether with different products and different securities and different contracts that you can enter into. Would monetary policy even work at that point? Have you not just crippled a central bank? You've eliminated the effectiveness of any central bank. That is an interesting question to ask. Because I think if you can get to that point where you do eliminate the effectiveness of the central bank, what are you left with? Again, the data just doesn't seem to fit. If you look at the fundamentals of the economy and you look at the shape of the curve Something is wrong. So either it's a different system that we have today, and a different system would mean the level of financial sophistication is so high that monetary policy has a very difficult time working. You've changed the nature of the system, or we're creating some measurement errors somewhere. We're measuring the wrong stuff. The yield curve can't be measured wrong. That we can see. All of this stuff over here is survey-based. Did something happen during the pandemic that changed the nature of the data? Is the data lying to us? Is the data even real? I tend to think it probably is. It'd be hard to get so much wrong data out, especially from so many different surveys. They all seem to be telling the same story. So the last implication is our star is way higher than what we think it is. In other words, if we've immunized monetary policy, then monetary policy has to go to a place where it's never gone before. I think this Jackson Hole Symposium will be interesting. Other things going on that don't seem to be mattering too much. Fed balance sheet down 4.7 billion, SOMA down 3.7 billion, so a net almost $1 billion runoff of the balance sheet. This is going to start going really, really slow at this point. I don't even, it's like watching paint dry every week. I'll still keep putting it up here, but I don't know that we're going to see much drop. I think a 5 handle is well over a year and a half away, if we even get there. Another interesting thing here, money market fund assets increased by 17 billion, both on retail and institutional. And if you look at ETF flows into equities in the US, way up. So money is flowing into the equity market, but it is not coming out of the money market. It's coming from somewhere else. And I have said this many times as well. There is nothing about this 6.07 trillion that says it belongs to the equity market, that it was hiding there for a while. Equity markets have been hitting all-time highs all through this year. And money market fund assets, other than for the tax season when there was a drawdown, have been going up. So something else is going into here that it is not related to the equity market. So I think when we hear analysts say, well, look, this market can grind higher, there's a lot of money on the sidelines, they love to trot out that excuse all the time. At that point, I think you could just cross out that sentence, strike it from the record, because this money does not belong to the equity market. Next, FOMC, 17 days away. We get a new summary of economic projections in there. Monday, we have markets that are closed. U.S. GDP for Q1, our second look at GDP for Q1, and our first look at gross national income in 4 days. In the U.S., PCE is 5 days away. In Canada, GDP for Q1 and a preliminary for April is 5 days away. So we get this on Friday. This is Thursday. Tuesday, Mester, Kashkari, and Cook. Wednesday, Williams and Bostic. Thursday, Williams and Logan. Friday, Bostic. We've heard from pretty much all of them already. I don't know that there's any incrementally new information. This past week was a busy week, and the basic theme of it is fewer rate cuts than what the market is thinking. I don't know that I agree with that completely. For June, almost no probability of a rate cut, 99.1% that nothing will happen. I think that's probably right for June, with 0.9 at the 25. Look at this for December. Look what showed up, a 5.75, a tiny probability. A fingernail on the island, but still it's there, 5.75. Somebody somewhere with the weight of their bets in the futures market is pushing a 5.75, a rate increase. And go back to the first screen. If we believe our star is much higher, if the general financial population has immunized themselves from monetary policy, then monetary policy is just going to have to try harder. I mean, that could be the thinking that, well, If the economy is doing what it's doing at 5.5, for good measure, why not bring it to 5.75 or 6 just to really do the job? It doesn't seem to be hurting anything. Maybe that is the thinking in there. But or at most one rate cut was 42.6%, is now 60.4%. And more than 3 is almost non-existent, 0.6% versus 3.5%. Fed funds rate still at 5.33. Reverse repo down 18 billion. In front of a long weekend, that's interesting. Usually in front of long weekends and at month end, they increase. Next Friday is May 31st. Typically at month end, we should see some kind of increase here. If it is a decrease, I would find that interesting. TGA 710 down 4.7 billion. Reserves 3.375 trillion, down 41 billion. So reverse repo plus reserves minus ample reserves, 1.3 trillion in runoff, my best guess. At 40 billion a month, 33 months, maybe 3 years of this slow bleeding off on the balance sheet. I, for one, don't think they'll get there. That if I had to bet on the balance sheet, what are we sitting at? 7 point something trillion dollars right now on the full balance sheet, 6.6 trillion on SOMA. But if I had to bet, I would bet 9 trillion before 5 trillion. Something will break somewhere. I mean, you have a whole globe and we're more interconnected than we think. Something will break somewhere. If they keep higher for longer, it just stands, in my mind, stands to reason that it would, because that's what it's supposed to do. And I think it probably would do it in an economy that isn't as insulated as the U.S. That I think the Fed will go back to its playbook of adding liquidity to the market, bringing rates back down. I would, if I had to bet today, I would bet 9 trillion before 5 trillion. Real rates all holding well above 2% right across the curve, but you are inverted, 220 to 216 to 214 from the 5 to the 10, 6 basis points, where we were upward sloping for a while. We're inverted again. Not much change on the break-even rates. Fed funds futures, what are they pricing in for Q2? Which is over in 36 days. Nothing, 0. Q3, half a rate cut, 13.5 basis points, and Q4, 24.5. So a total of 38, somewhat less than 2, versus the last summary of economic projections, which had 75. Last week it was negative 43. Now we have 38, fewer basis points in there. I still think a low-risk strategy is to be long Fed funds futures for the end of the year, whether it be December a contract or a January contract. TLT down 0.01% week over week, basically unchanged. SPX up 0.03%, basically unchanged. Although we did have quite a roller coaster ride. TLT didn't like the start of the week, but then thought, no, everything is fine. No, it's not. Yeah, everything is fine. No, it's not. Well, maybe let's just get off where we started. And you'd think that would introduce volatility, right? Nope, still 0. Premiums don't justify the margin. No matter how I look at it, no matter where I'd like to sell some puts on this because I think 90, 89 make a lot of sense. There's just no money in it at all. That when you look at how much margin you have to put aside for the premium that you get, there's just better fights. There's just, I think, a lot of positions you could take that are just as, I think, low in risk of assignment as TLT, with premiums that are, significantly higher, as much as 6% of the margin as opposed to 0.5% or 1%. But the premium doesn't justify the margin, so I'm simply not going to play in this space. Okay, mortgage rates back under 7%, 6.94 over the observation period of time, the 10-year Treasury add 9 basis points, while the 30-year lost 8. So the spread contracted 17 basis points to 247. ABR 1337. I said last week that I had sold all of my ABR on the short squeeze earlier in the week, and I sold $14, $15, and $16 calls. Closed the 16s. I still have the 14 and the 15. I'll close the 15 if I get 15 cents. I will close the 14s if I see 15 to 20 cents, because at 15 cents left, these are July's, at 15 cents all the way to July, the 15 doesn't justify the margin. Same with the 20, it wouldn't justify the margin, so I'm more than happy to close it. Down 3.74 week over week. ABR has a book value per share of $13.06. The only question is, for a mortgage REIT like this, should it trade at a premium or at a discount to its book value per share? I seem to think that in and around 13 to a slight premium makes sense. 13 to 13.50 last week I said is where I think I could see Arbor, going sideways for a while. Got below 13.20, tried to get above 13.50, but pretty much hung out in the 13 to 13.50 range. I think it stays there, and I think that theta and the decrease in volatility over time will bring the premiums down, so where I can close these. Existing home sales for April, got this number last week, negative 1.9 month over month. New home sales down 4.7 month over month. So home sales dropping. Well, it kind of made sense with interest rates so high, right? It's the incrementally new buyer that pays these interest rates. Somebody who has a mortgage from 2019 doesn't pay that, is completely immune to that. Mortgage apps for May 17th up 1.9%. Tuesday we get housing price information, the housing price index, and Case-Shiller as well. October still is the series high on Case-Shiller and I think on the housing price index. And it wasn't that much below the last reading we got for February. It wasn't that much below the series high. That I think all you needed was like a 0.3 increase in home prices and you'd be there. So are we going to see a series high in Case-Shiller for March? Thursday we have pending home sales for April. OAS, nothing to see here. When I say nothing, look at this, zero. There's 1 basis point, 1 basis point. There's nothing to see here. I can imagine if I had a podcast where I talked about the OAS each week, it would be 33 seconds long. Welcome to the show. There's nothing to see here this week. If you like what you heard, smash the like button and hit subscribe. I'll see you next week. There you go. I just did an OAS podcast. What do you think of that? Let's look at position reporting. This is sort of a look ahead. I'll put out a longer video on this one, but this is what I plan to do in the applied level starting in September. It'll be in the portfolio construction module. Is at the beginning of the week on a Sunday, I will lay out my position, the position that I want to take. I will also lay out my thesis of why I want that position and my trade strategy, whether I'm selling out of the money puts, in the money puts, what delta I'm selling that, how many, if I plan to sell more puts over time or I'm looking to get my whole position, or if I'm just going to buy something directly at a certain price. Now, during the week, I'll still be taking positions that I would not have told you about because I would not have known about them. Because during the week, stuff happens. Things go on sale. For example, on the Monday when GameStop started running, I didn't know I was going to sell ABR, so I couldn't have told you that on Sunday because I had no idea. But by Tuesday, it was pretty obvious what was going on. So I took that advantage because things show up. I will tell you about those after. So on Sundays, you'll have, this is what I did last week, and this is what I plan to do this week. I'm not a big fan of telling you what I did after the fact because I could just make anything up, right? I mean, when you watch some videos, I did this, I traded this at this price, got in here, got out there, it all looks a little too perfect. And is it true? Did you actually do that? tell me in advance. And I've said this about Kramer's show before. If you really want to impress me, have your show on at 6 a.m. Tell me what's going to happen that day. I mean, it's easy to have a show at 6 p.m. and tell you what happened in the market that day. That's easy to do. But if you really want to be impressive, have your show before the market opens. And let's see how right you are on that. So I really want to stick with, as much as possible, telling you what I'm going to do in advance of doing it. So let's just go through some of these positions that I did this week. Newmont and Freeport are related, gold and copper and gold. Newmont $40 puts for June, I got 73 cents. And FCX on the sell-off of the copper contract on Thursday, 47 puts for July at 106. Comfortable with those. Newmont is a gold miner that produces a lot of copper. Freeport is a copper miner that produces a lot of gold, so much so out of Indonesia that by the time they sell the gold, the copper has a negative cost. In other words, they're already profitable before they even sell the copper. I like that idea. If you are bullish on the long-term nature of copper, it makes sense to grab both Newmont and Freeport. You have data center, you have AI, you have robotics, you have automation, you have the transition to green energy, you have EV, you have charging stations. You look at the regulators for the auto industry, both the EPA and NHTSA, and it's not just in the U.S. These regulations are in Europe, in China, in South America. Their form of regulation where emissions each year have to go down and average mileage has to go up. The OEMs have no choice but to introduce more hybrids and more EVs into their lineup. They have no choice or face big fines. Well, it's cheaper to lose money on an EV than to pay the fine. So that means more copper, more EVs, more copper. So this was an easy play to make. If you think that copper is going to be a big thing because you're going to be moving more electrons around, you have to like energy. You have to like the utilities. So NextEra Energy, 72.50 puts for July, got $1.64 on that one. And GM for July, the 42 puts, I got 84 cents. This is purely a valuation play. They've pushed out their EV investments. They've pulled back the aggressive investments they were making in cruise, and their growth capex in ICE. Well, I don't know that you want any growth capex in ICE. So they are basically a cash cow right now. They're kind of like cigarettes, right? There's not a growth market for cigarettes, but you're not going to put a lot of money into it. You're just going to harvest. And I think given the cash that they bring off and the valuation based on that multiple of cash, it's just a ridiculously cheap company to buy. And management has already shown itself, thank God, has already shown itself willing to do big buybacks if they're not getting respect in the market. $10 billion accelerated buyback last year. So if they continue to get no respect, being that they have used that in the past, they've shown themselves willing to do that, I think they'll do it again. So I'm comfortable with GM at the 42 level. If it's put to me, great. If it's not, well, I make money by selling the puts. I've also added to my Canadian apartment REIT positions Minto, 1520 down to 1480. I was able to add 7,400 shares. And Interrent under 12, I've got 6,100 shares on that one. Cap REIT, I added more puts, $44 puts, 99 cents for July. I did 50 of those. And I added another 100 of the July 46 puts for 190. So this would give me, if it were put to me, a price of 43.01. And if this were put to me here, this would give me a price of 44.10. So with the 100, I now have 250 of these here. My logic here is quite simple. These are all trading at discounts to net asset value, and we still have a housing shortage. Canada is IFRS, not US GAAP, so any investment property is listed at fair value. As you have interest rates dropping, We have a housing shortage, which should keep NOI. In worst case scenario, NOI would grow at 2 to 3%. If nobody moved out, NOI would grow at 2 to 3%. As you have people moving out, then rents reset to market rates. So you have NOI that is growing. So if you have a numerator that is growing and you have interest rates that are dropping, you would have a denominator that is decreasing. You get fair value gains. So net asset value is going to increase. If the prices don't increase, it deepens the discount to net asset value. Keep in mind, you still got a housing shortage on top of all of that. So I don't know. I can't, in my mind, imagine a scenario in which net asset values start to decrease. How would that happen? That rents would start to decrease with a housing shortage and massive population increases. If anyone can figure that out, let me know. I don't know what I would be missing here, but it seems to me this discount to net asset value can't hold once the Bank of Canada starts cutting rates. Once they start cutting rates, these things are going to get a bid. I think there's a very high probability they cut rates at the next meeting, because our last reading on inflation, I mean, we're there. I mean, we're really there. And unless you cut rates, you're not going to get more housing units being built. I've made this argument last week simply because development costs are simply too high, and that there are projects that have been put on hold until interest rates come back down. If you want to alleviate the stress on housing markets, you have to make it cheaper to build, and the financing cost is a big thing. So the Canadian apartment REITs, to me, was straightforward. Newmont and Freeport are longer-term plays on copper. Same with NextEra, and GM is purely valuation. I am looking at AT&T, and I have to make a decision whether I'm looking at the $18 or the $17 puts. AT&T seems to be holding firmly around the mid-17s. There's not a lot of premium in the 17 puts, but at the same time, there's not a lot of margin that's required. So it's still a fair return on it. Just, I kind of like to see 30, 40, 50 cents if I can, which I'm not seeing at this point. So if over the next couple of weeks I see AT&T drift down to 17, I'll sell the 17 puts. If it's going to hang out here, I'm going to move my put price up to the $18 put. For the last 2 months, copper prices have advanced from under $4 a pound to this past week almost $5.19 a pound. I think it hit $5.20 a pound intraday, not on a closing basis. And then one day last week lost 30 cents. The contract lost 30 cents in one day. That is momentum leaving the trade, or it looks like momentum leaving the trade. I think what is a better way of positioning that, rather than saying momentum was leaving the trade, there is evidence here that suggests that it was short covering that ran the contract up to 519 and 520. And then something happened in China which allowed the price to retreat to more reasonable levels to reflect incoming supply. So let's see if I can lay this out for you. Let's look at our first chart up here. Global copper stocks are at a 3-year high after China rebuild. This bar here is January 2024. This is April of 2024. The red part of the bar is inventory at Shanghai Futures Exchange. Look at what happened during during February, March, and April. Copper stocks in China just exploded for two reasons. The importation of copper concentrate was higher year over year, and the importation of refined copper was higher year over year, but exports were lower and domestic use was lower. So in March of this year, some Chinese smelters decided to shut down, and that started the whole rally. That brought COMEX copper from 395 to above 4. It ran to about 425, 430. And I had said at that time that I think that run is a little bit overdone because there was overcapacity in China to begin with. So they shut down some smelters. It shouldn't have much of an effect. I am long-term bullish on copper. But in the short term, there is enough supply to meet the demand that exists. So to see that run up from 430 to 450 to 470 to 490 to 510 to 520, you're left scratching your head saying, but we don't have a shortage yet. This can't possibly be pricing in the 2025, 2026 potential shortage. So something must be up. Let's just look at inventory levels here. London Metal Exchange, 105,900 metric tons. Shanghai Futures Exchange, we can add both the 45,000 metric tons up here and the 291,000 down here. Contrast that with the CME, 18,000 metric tons. This little yellow part in here, that's the CME. We'll come back to that. Why is that so low and China is so high? We'll come back to that when we talk about this bottom chart. Let's move over here and look at China's refined copper imports. Running at robust rates, up 17% year over year in the January to April period. That is 1.25 million metric tons that were imported over that period of time. Net imports are up 26% year over year. So if your imports are up 1.25 million metric tons, if they're up 17% year over year, but net imports are up 26%, that means over that same period of time, exports must have been lower. So it means weaker exports. So we have a situation, as we can see in the first chart, where you have a US shortage and a China surplus. Here's the problem. The CME does not allow delivery of Chinese copper. So you cannot just redirect this. You cannot say, well, there's a lot over here and there's a shortage over here. And those who are short the copper contract either have to cover or deliver. Why don't they just deliver this? Can't. Same with Russian copper. You can't do that. So copper has been heading into China. Look at this bottom chart over here. The import premium is now negative $5 per metric ton. In other words, to send your copper to China, you'll get less than the market price because the premium is now negative. By the way, that is the first time in the data series that it has turned negative, and that has turned negative in just the past week or so. There was a premium to delivering to China prior to that, and we can see that that premium certainly was taken advantage of in the speed at which copper stocks were built up. And now it's negative, which allows copper that was flowing to China to now be directed to the U.S. to fulfill any shortage that the short side of a copper contract has. It increases their ability now to actually deliver the metal as opposed to short covering. So there was, we'll look at the copper chart in a second here. There was that massive run up earlier in the week where copper was flirting around with all-time highs, 518, 519, and then just a 30-cent crash. When the delivery premium here, or the import premium, turned negative, it makes a lot more sense to redirect your copper to the U.S. So there is an expectation of massive deliveries coming in to the CME, such that 18,200 metric tons is set to massively increase. And again, when you think about global copper stocks, at a 3-year high. Okay, let's take a look at a 1-month chart of copper, and we'll put a line across there. Actually, we'll extend it all the way to the other side. Look at these massive run-ups that you have in here. Big moves per day. This is not typical of copper. And if you're into candlestick charting at all, the big wicks should have highlighted that there's a lot of volatility going on. Something is happening. These are not fundamental moves. This is short covering. Twice, the all-time high here, all-time high closing February 2022, 518.71. It attempted that twice. And this, you have a pullback. If you were just looking at the chart and looking at the technicals and ignoring any of the fundamental story behind copper, you might have think that, well, you have a double top, and when it fails the second time, you generally have a retreat in price, and then you'll have another run-up to break through, because as technical analysts believe, there are no triple tops. However, fundamentally, what happened during this period of time, the China premium went to less than zero. So COMEX deliveries are expected to increase. Global copper shipments will be routed to the US because the short position can now deliver rather than be forced to cover. If the copper is sitting within China, it cannot come to the US as delivery under the CME contract. But rather than it entering China to begin with from South America, it can just make the trip up to the US. So rather than China importing more copper, because it's already sitting on a lot of stocks, that premium is now negative. If I were shipping copper from South America, I would say, you know what, it's worth it for me to ship it to the US and deliver there. So this is what this was about, is that a belief that the deliveries for COMEX are going to increase dramatically, such that the short position is not now forced to cover. So what do we make of this? Citigroup believes the price will consolidate here, sitting around 475. Consolidate here would probably mean somewhere in around, I guess, 450 to 490, somewhere in there. JP Morgan believes copper prices are too high. I sort of side with that as well, but believes miners are at fair value. Copper price is too high. If we look at this channel here, the bottom of this channel is somewhere around 445, so that you could retrace another 30 cents down on the contract. I seem to think that we could see 425, 420, because I thought the run up to $4.30 after the shutdown of the Chinese smelter was a little overdone. And I had said at the time that it ran up to that price that we don't have a shortage of copper yet. We are going to have a shortage of copper, so long term I'm bullish on copper, but we don't have it yet. So this run from 395 all the way to 520 was overdone. It didn't make sense, but you do not short momentum for whatever reason. Okay, maybe it's short covering. You just don't step in the way. But now that we have a fundamental reason why supplies in the U.S. will increase with this China premium less than zero, with China stock sitting, I think it's something at a 3-year high, they have no real desire to continue to increase their copper stocks. I think you'll see it increase in the U.S. Also last week, a well-known commodity trader, Anuran, who has fairly good pedigree. He's very well known, considered one of the best commodity traders out there. Previous history with Goldman Sachs. Put a price target of 40,000 per metric ton. And to put it in context, during the peak of the short covering here, it would have translated to about 11.4 thousand per metric ton. So this is almost more than a tripling of the price over the next 4 years. But to put things in context, last year he made a big bet on oil, saying the same thing about oil, that it's going straight up, and that trade lost 55%. When you lose 55%, you need more than 100% just to get even. And the copper trade this year has made, I think the report that we saw, up 83% just on the copper run. So he's almost at break even. So you've got to do something to put the fear of missing out in there, and to say that, yeah, we've had a big run, but we're nowhere near over. I mean, you're talking at $40,000 per ton. What are we looking at? $17, $18 a pound? I don't think so. I think that once you start seeing $7 and $8 a pound of existing mines that are out there with low yield ore, it's going to make that ore profitable again. Without having to build out new mines, you can meet that supply, but not unless you get the price higher than $5 now. So I agree with him on the direction. I just don't agree with him on the price. So when I read this, I was, he's talking his book. He has to talk his book. He needs to save his return. I am bullish long-term on copper because the fundamental story hasn't changed. Charging infrastructure, you need to build that out massively because EV is going to continue. It may be in a lull right now, but with regulation in Europe, in China, in South America, in North America, with regulation on emissions and CAFE standards, fuel efficiency standards, the auto assemblers will have no choice but to put more EVs into their fleet or more hybrids. That is more copper. And if you really want a rollout by a certain date, you have to massively upgrade the charging infrastructure. Anytime you're moving electrons and not carbon molecules, you need copper. Upgrading the energy grid, green and renewable transition continues on. Data centers, I don't think I need to tell you that story. AI, automation. The world is becoming more and more and more digital. Those require electrons. Electrons need copper. Crypto mining. I'm not a big fan of the whole crypto space. I don't quite agree with the whole crypto space. However, with ETFs, now an ETF approved for Ethereum, with Bitcoin ETFs, it institutionalizes its credibility. Little by little, it becomes more acceptable and a wider market for it. So with more activity, potentially you're going to need more mining. Crypto mining is hugely energy intensive. You need copper. I think you see where I'm going here. So demand for copper is going to increase, but as of right now, there is enough mine supply in the world to meet the demand. It's just you have the mine supply that will increase like this, and you have the demand that will increase like this, and somewhere in 2025, 2026, onwards, you're going to have shortages. The price is going to have to increase. But this, I think, was just the wrong move. All right, let's look at SPY. Hardly moved week over week, closing SPX 5304.72. Looking at our forward 4-quarter operating earnings. Keep in mind this is operating earnings, not EPS. If we look at actually what the EPS is, it is lower than both of these numbers, which means if we're looking at the forward multiple based on earnings per share, it would be much higher than this 21 times forward earnings. We're just stopping at operating earnings here. 250.261 down slightly from LSEG, 249.84 down slightly from SPGlobal. So our multiple, we have a market that's continuing to go up purely on multiple expansion, 21.12 versus 21.09. Surprise factor for Q1, sitting at 8.1%. So if we say, well, let's say that the earnings continue to surprise by 8.1%, sitting at 19.53. Versus 19.49, and again, operating earnings, not EPS. Implied volatility, well, there is something here finally, right? 15% on the 13-week, 27 on the 26-week from 2, 4, and 2. And closing, still closed below the all-time high. The all-time high did happen during the course of the week. You had Tuesday, Wednesday, I think one of those 2 days, we hit another all-time high. For earnings next week, LSEG has 10. Same with Sector Spider has 10. SPGlobal has 8. I'm not going to rant about that. Wednesday, Salesforce.com and HP. These are notables. Thursday, Dollar General, Best Buy, and Costco. And from Morningstar, I got this little chart. The Wall Street firm for 2024, S&P 500 target as of May. Morgan Stanley is the only one here that has a 12-month forecast. The rest are end of year. BMO, 5,600 at the high end, implying 5.59% upside. Look at JP Morgan, 4,200. 42. I have, they are my external money manager. I wonder if they're managing it for a 4,200 target. If they are, I am not having a good time on the market rallies with them, am I? I should check in from week to week. Although I don't know if they're if the wealth management division really follows the research side. I'm not really sure, but I saw that. I thought, I hope they're not positioned for that. Average is 52.89. We're sitting at 53.04. That is 0.3% off. We're basically now at the average of the year-end target. The median is 5,400, so small upside. Look at this one over here. Fundstrat, 5,200. Now that is very odd. Usually they follow a strategy, not so much of figuring out what the target is, but trying to figure out what the highest target is so they could be the highest on the list so that they have visibility. And the strategy there is markets go up 70% of the time. So if we are really bullish all the time and we're at the top of the list and markets go up, we'll get some benefit from that. Very rarely are they in the middle of the crowd. Usually they're the highest ones out there, not because they believe it, but because it's important for them to be at the top of the list for that visibility. That's really what they're looking to get done. I find it odd that they're sitting at 5,200, but there are some year-end targets. We're kind of right here. I drew the line here. We're 5,304, so all of these are slightly below. These are above. Even Yardini 5,400. He's considered sort of like, he's always bullish. Who's the other guy from Canada? David Rosenberg. He's always bearish. Yardini's always bullish. 5,400. That still isn't that much higher than where we are. And this is as of May. So these are the most recent year-end targets. Let's have a look at NVIDIA. Okay, here is NVIDIA's quarterly revenue trend from their site. Just go to Investor Relations and you'll find this. Revenue by markets. Data center, here is Q1 2025. Data center 22.5 billion. Total revenue 26 billion. You can see data center revenue quarter over quarter up 22.6%. Gaming down 7.61%, but still, I'm not going to hold their feet to the fire on this one. 2.6 billion. You go back, 2.4, 2.2, 1.8, 1.5. Still pretty healthy, even though it's below the last two. It could be a seasonality thing in here. Professional visualization down 7.8, but auto up 17.1. If you look at these two, quarter over quarter, it's about flat. So not much you can say there. And they're small numbers compared to what data center is doing. And then OEM down 13.3, but it is small. This is a data center company, plain and simple, based on the weight of where all its revenue is. Looking at its growth quarter over quarter, from Q4 to Q1, this is what really started everything off. 18.5%. It was their guidance here for 50% that started the rally and started the whole AI hype. 141% to 10 billion, 40% to 14, 26% higher to 18, 22% higher to 22. So you can see the growth is sort of tapering off. However, if you look at it in dollar terms, it's fairly constant. You had a roughly about a $4 billion build here, 4.2 quarter over quarter, followed by 3.9 quarter over quarter, followed by 4.2. So they're adding about $4 billion each quarter. That's pretty amazing in the data center space. Closing price 1,064.69. Market cap 2.62 trillion. Third most valuable company out there behind Microsoft and Apple. Earnings per share 5.98. 21% quarter over quarter growth. If I forecast that out for 4 quarters, I get 39.40. This is the 4-quarter EPS given 21% growth quarter over quarter. If they maintain that, that means they have a current forward PE of 27 times. But again, it's everything after the given sign is the important part, right? Given that we accept a 21% quarter over quarter growth rate, we get to a 27 times forward PE. If we just take EPS of $6 and we multiply it by 4 and say, well, the next 4 quarters will just be flat at $6, given this price, they are 44 times forward earnings. So they're somewhere, if maybe we don't accept the 21% for 4 quarters straight, that might be aggressive. You're somewhere between 27 and 44 times forward earnings on a company with probably at least 50% growth over the next year. If you're not going to accept 100% growth, maybe 50% growth. PEG ratio less than 1. This is growth at a reasonable price. 10-for-1 stock split coming in June 7th. Sitting on their balance sheet, they have $31.4 billion in cash equivalents, and marketable securities. Not a lot, considering a market cap of $2.62 trillion. That doesn't even make a dent. If you spent it all in buybacks, you wouldn't even make a dent in that probably not worth it. Gross margins, look at that, 78.45% gross margins. That's huge. Net income margin, 57.13. This is the real deal here. The only real question you have, because this is a data center play, pure and simple, it's data center. All the other ones are, well, they're mixed. Some are up, some are down, they're mixed. It's really data center that's adding $4 billion per quarter. Is what is the forecast horizon for this level of growth? Now you can argue, well, look, it's only been a year. Build outs like this, especially, it's being called the next industrial revolution. This could be the next 5, 6, 7 years. I've heard estimates thrown around that this is a $1 trillion build out. And if you're only grabbing 22 billion per quarter, let's say, 100 billion, 150 billion per year, you've got what, 7 to 10 year build out in this company to get there. Or you could look at it in the sense of there's so much infrastructure that you need, and once you get to that infrastructure, you may have churn in the types of customers that are using the data centers, but you're not going to continually need new data centers for every single business that wants to do something. Once they train a model, they may no longer need the capacity that data center offers. And in every investment space that you have where there's a big rush of investment because there's a new type of industrial revolution happening, there's always overcapacity that gets built in, and then a lot of companies simply don't make it. When we look at the VC space, money's rushing into AI firms everywhere, and these AI firms need compute power, and that's what's driving this right now. Well, is there going to be a fallout? Is there going to be a number of them that simply just disappear? So that's the big question here. NVIDIA is an investment for as long as you think the infrastructure isn't done yet. But once you think the infrastructure is done, it's not the end of the AI story, it's the end of the infrastructure for AI. And if you are not comfortable paying these sorts of fees, even if you think, when I say fees, you don't like the 27 times forward earnings, even if we do have a limit to the build out, at some point, let's say that you have enough data centers, well, that's fine, but all those data centers will still use electrons. You're still going to need copper. And if we look at copper mining companies and look at the multiple there, and utility companies and look at the multiple there, that is the natural play to make, as opposed to saying, well, which software company is going to be the one that wins? How long can this hardware build out happen for? Who are the companies with the most data that are going to benefit the most from AI and the AI models? And I think here we have to really focus on the letters AI to put this in perspective. And I think the stress should be on the A, not the I. This is artificial. It's not intelligence, it's artificial. It's code. At the end of the day, this is code. Code does not have a mind. I've used this line before with my business and my IT staff, that something isn't working all the time. that this function, you click on it, it works, but sometimes it doesn't work. And sometimes I get an answer of, well, that does happen. My pushback was always, no, it doesn't. Code does not make up its mind. It either works or it does not work. So if it's working 90% of the time and not 10% of the time, it's something wrong with the code. We can't say that we have a sentient being in our system that's deciding on Monday morning it doesn't want to execute some instructions. It either works or it doesn't. In the end, this is artificial. It is just code. When you pull back the curtain on this, you start to see a whole bunch of evidence, anecdotal evidence, that says this is not really the big leap that we need. This has been a big leap forward, but this is not intelligence. We are not at the level of intelligence anywhere near. We're still artificial. So Waymo taxis drive around. Let me do this. They're driving around. When they get to a point where they have to make a decision, they stop. If the uncertainty is below some level, they stop. They send a signal back to a place where a person is sitting and can look at the situation and then tells the car what to do. So there is something going on behind the scene. It's not intelligent, it's just code. How many times or do you know anybody this has happened to? Whether it be Instagram, Facebook, LinkedIn, you're going along your day perfectly fine, then suddenly you find out that your account is suspended because you violated community guidelines. And you're thinking, well, what have I done? What community guidelines have I violated? I haven't done a damn thing. But the policy is we don't tell you what community guidelines you've violated. We're going to have somebody review your file. Somebody reviews it and you're okay, and you say, well, what happened? We don't tell you what happened. So here's what happened. The AI model was wrong and just said, oh, you're violating community guidelines, I'm suspending your account. And then you have a human that intervenes that says, well, no, that wasn't the case, here you go. But they can't tell you, oh, our AI just isn't working very well, because, well, that wouldn't look good, especially for a Facebook or Microsoft that owns LinkedIn. It just wouldn't look good to say our AI really isn't working very well. So this is how weak it is. I set up the Instagram account so that I can give notifications to our Applied Series subscribers when a new video is added. And I had done nothing. I simply just set it up. I hadn't even done anything with it. You just create a new account, and I was immediately flagged for violating their community guidelines. Thinking, what have I done? And we are not going to tell you what you've done. And then after, I had to upload some documents to prove I was me. And then after, everything was fine, and the answer was, we're not going to tell you what you did. Just don't do it again. Don't do what again? Imagine if you lived in a society that had a set of laws, and flying around were artificial intelligence, surveillance systems, police officers, let's call it, was all AI. But you did not know the laws. I mean, how do you navigate a system in which you do not know the laws? Clearly, that cannot be the case. Clearly, if you're getting arrested at random, it must be because the AI is wrong, not because you're breaking any laws. It cannot be a case where here's our system, we're not going to tell you what the rules are, but just don't you dare break them. I don't think we're at the level of intelligence. I still think we're at the level of artificial. However, that does not mean there is no build-up. That does not mean that the hardware isn't going to win. I just am skeptical about the pace at which all of this is going to happen. As of right now, NVIDIA is still in the game. It's still a play. Until you see a crack in the data center growth, until you see some evidence or some hint on the horizon that, you know what, it seems like everything is built out because everyone is thinking this is intelligence, but it's only artificial. So all of this big hype, these companies are starting to fail, much like the internet. When we got to early 2001, I think it was in 2000 or 2001, that's when everyone started saying, wait a minute here, like everyone rushed to set up a site, everyone's got a whole bunch of eyeballs, but who's making any money? How is this stuff's not really where it's supposed to be? And then companies just started failing left, right, and center, and we realized that, wow, we got a lot of capacity. And I see no reason why this won't repeat. I think there'll be a massive fallout in all of these models, that it will get to the point saying, okay, you know what, we've made some good progress, but what these things are really great data processing models, but they're not intelligent. They are artificial. They are at the heart of it code. Until you can get to the point where you can generate something. Now, we do have something called generative AI, but I don't know that it's really generating much more than what it already can find. I don't think that it's making up its mind about anything. So I think that is a problem here. I think there'll be a growing acceptance that this is the artificial part of it, not the intelligence, but the artificial part. that is when I think you'll start seeing the cracks in the growth in capacity that is needed. But it's not now. For now, it is semiconductors, it is copper, and it is utilities. That is the ecosystem of the picks, axe, and shovels.